the 50-year mortgage, or what I like to call it, the 600-month mortgage, seems to be a really polarizing topic right now. So I wanted to talk about it and what it would actually look like in practice and give you some real-time numbers. But first, I wanted to just touch on that whenever I talk to a home buyer, it's usually first-time home buyers. Our initial conversation about what home they are purchasing, the common sentiment is, I'm not going to live in this house forever. This is just my starter home. And they're usually buying it at a young age because they know that this property will set them up for a little bit of wealth, whether they are going to sell it or keep it as a rental property or what have you. But we know on average that somebody will move, buy, or sell every 7 years. So when I'm having these initial conversations, this person is probably not going to stay in this property, but the equity that they are going to be earning in this home is going to set them up for success, whether it is selling the property or refinancing and lowering that loan to value. There's a whole list of things. So I want to show you what a 50-year mortgage versus a 30-year mortgage actually looks like. So if we take a loan amount of $400,000 and I'm using a interest rate of 6%, just to give us some whole numbers. But keep in mind that on a 50-year mortgage, I have to assume the mortgage interest rate is going to be higher on a 30-year, because if we look at the 15-year and the 30-year, the 15-year is much lower than the 30-year mortgage. So you would have to assume that a 50-year mortgage would be higher than where the 30-year is. But let's use 6% as an average interest rate for both scenarios. So if I take a $400,000 loan amount and I'm looking at a monthly payment of just principal and interest, so not taxes, not insurance, none of that, your 30-year payment, you're looking at right around $2,400. On your 50-year payment, you're looking at right around $2,100. So yes, it is saving you $300 a month. But for some people, that $300 difference is huge. They absolutely need that in their monthly budget. For the average person buying a $400,000 loan amount, I look at bank statements all the time. It doesn't make as big of a difference as you would think in your monthly budget, in your monthly spending. It just doesn't. And so for somebody to say that it's a huge savings and, it can help you qualify for so much more, in some cases it can help you qualify for so much more. That is if you're kind of going right up to your debt to income ratio, and it can make homeownership happen for that person. But for the average person, $300 a month is not making a huge dent. Then we have to look at 7 years later when you're on month 84 and you maybe are going to sell. How much equity will you actually have? Because I want you to have enough equity to be able to put a significant down payment on your new home. So natural equity is the average price of homes continues to go up, but the equity that you have earned in the property, how much will that actually look like apples to apples? On the 50-year mortgage, you'll have about $11,000. On the 30-year mortgage, you'll have close to $41,000. So you'll have a much larger, significant down payment on your next home. This can also really play into if you go to refinance, your loan to value will be a lot less if you're continuously paying towards that principal a little bit more on the 30-year. So that is kind of the real life of the 30-year versus the 50-year. What I think, now I think the 50-year can work in some scenarios. Is it going to be whether a person buys or they don't buy, and what does that affordability look like? And I think that there is always going to be a time and a place of, does this work for somebody? But I don't think that we should automatically start defaulting to a 50-year mortgage, because I think that we're not setting people up for success. I think that a successful way of going about things is discussing their options, and this is what it's going to look like and what your amortization is going to look like in this home. But defaulting to that 30-year mortgage, or even a lower mortgage in some cases, some people choose to do a 15-year or 20-year just because the interest rate is lower and they want to pay down that principal. I think that's really where we should be going towards. We should not take it upon ourselves to start defaulting to this 50-year mortgage. So those are kind of my thoughts on what this actually looks like as far as a monthly payment. There are so many people out there and so many scenarios that this is not a perfect science, and not everything is going to work for everyone. I just wanted to give you my thoughts. Please leave your thoughts below. My name is Kendall. I am a loan officer. I help people every single day purchase their home, and we dive into these numbers all the time. So if you need help or you want to have an honest conversation of what this would look like, I would love to help you. But please leave your thoughts below, because I love talking about these hot button topics and what they actually look like.